Hi, good morning, everyone. Welcome to today's webinar. Today is 26 August 2019. So today we will give updates on two counters, Golden Energy and Resources, as well as CapitaLand. Meanwhile, we'll give updates on US, China, REITs, and the technical outlook. So let's start with Golden Energy Resources 2Q results update. So we are seizing the coverage on this counter. We downgrade our call from accumulate to neutral with a lower target price of 19 cents. Our previous target price was 24 cents. The positives for this counter in 2Q was that the production volume still continue to grow, and it is on track to hit the annual target of 25 million tons. So as you can see that as of June this year, Gear has produced 12.6 million tons of coal. Meanwhile, the management guided that the full year cash cost will be range from $25 per ton to $26 per ton. And another positive was that Gear invested in two equities listed in Australia, Wesco, as well as Stanmore Coal. So as of 22nd August, these two counters perform quite well. So especially for Stanmore Coal, it is making about 35% to 40% on paper now. And also the Wesco today open at a higher price now. So it is expected that the investment on these two counter will continue to profit Gear. However, the negatives for this counter is still the sluggish coal prices. So the 2Q ICI for coal prices continue to drop. So you can see here down 16% year on year and 2.8% quarter on quarter. So the outlook for this counter will be quite lackluster because of the lower coal prices, and the downturn of this coal market is expected to continue. So overall, the performance in this year will be jagged by the correction of the coal prices, and the overall performance will be comparable to what they did in last year. Thank you. So next, I'll pass on to Natalie.
Thanks, Guangzi. So I'll be presenting CapitaLand's second quarter results. So we are upgrading CapitaLand from accumulate to a buy with a higher target price of $4.20 from $4. This is due to the inclusion of the merger of Ascender Singbridge. So for 2Q results, revenue actually fell by about 19%. This is due to the lower handover of residential projects from China as well as Vietnam. Also note that some of the in 2Q they handed over about 2,300 units in China. However, a bulk of this was actually under associate and hence not recorded in the top line. Overall, the EBIT and PATMI was lower due to the realization of Ascender Singbridge related transaction cost of $36 million. On the positive side, post ASB merger gearing increased to 0.73 times. This is in line with the management's expectations. And the management has plans to delever to 0.64 net debt to equity by end 2020. With their very focused divestment for the first half of 2019, they actually managed to divest about 3.4 billion worth of assets. So, and this divestment has actually unlocked about $135 million worth of capital gains. Another positive side is that a large portion of the PATMI was actually attributed to revaluation gains. About 60% of it was attributed to revaluation gains. However, this is the revaluation gains were actually operationally driven, meaning that the cost for the gains is actually due to a higher net property income from some of the assets, and this operationally driven revaluation actually accounted for about 58% of the revaluation gains. Other parts of revaluation gain were like contributed from Funan, which was topped up. So in China, China actually faced price caps for the later part of 2018, resulting in much lower selling prices for the China residential assets. However, as of first Q, they actually CapitaLand actually managed to increase the selling prices by 53% from 4Q 2018. And in the second quarter of this year, they actually increased an additional 15% above the 53% that was achieved in 1Q. So this is basically a gradual relaxation of the price caps, and CapitaLand was able to increase their selling prices for the China residential properties. The sales momentum remains healthy, although we do note that the sell-through rates for units launched in 2Q was actually slightly lower at 80% compared to 90% in first quarter. However, overall sales rate remains healthy for China at 93% for all launches. So we remain optimistic about the remaining 3,000 units to be launched in 2Q in light of the gradual lifting of price caps in China. And CapitaLand is growing their recurring income stream through their fund management platforms. Post ASB combination, the number of private funds increased from 17 to 23. So CapitaLand will be earning management fees for the management of these assets within the funds. And also, CapitaLand's lodging segment, which is the Escort Limited, is actually increasing the number of keys under management via management contracts. So for each 10,000 keys on a stabilized basis, the management actually guided that it will add additional 25 million worth of fee revenue to for Escort, and this is actually stable and recurring. So this will help to sort of smoothen out the volatility that's from the developer side. So the graph on the right actually shows you how. Okay, so currently, right, there's about 44 keys that are still under development, and the operational keys, they are contributing 14.4% to EBIT. Oh, sorry. Yeah, the lodging segment is actually contributing 14.4% to EBIT, and a large portion of this is actually recurring fees. So about 41% of it is from the recurring management contracts. So this is an asset-light model, and they're expected to continue increasing the number of keys, and their target is to reach 160,000 keys by 2023. Looking ahead, apart from the potential redevelopment of Liang Court together with CDL and ART as well as CDL HT, CapitaLand is also looking at some of the industrial assets in the Jurong area for potential redevelopment or rejuvenation. Okay, so I'm gonna flash the RNAV table. So this is updated to include the ASB merger. So moving on to the Singapore REITs monthly for the month of August, we note that SREITs total return is up 21.7% year to date. This has outstripped the STI as well as the real estate index. So the graph on the left plots the price of the FTSE real estate REIT index, and correspondingly the dividend yield spread. So the dividend yield actually crept up and above the negative one SD mark for August, but then as of 26 August, it actually fell back down and is currently now at the negative 1.3 standard deviation range. And the yield spread above the 10-year yield is actually 2.88%. And in in July, we actually saw the first rate cut of 25 basis points since 2008. The lower Fed fund rate also resulted in a lower SAW as well as 10-year Singapore SGS yield. Moving on to subsector indicators. For the retail subsector, we note that the retail price index actually fell slightly quarter on quarter. However, we noticed a very sharp improvement in the retail occupancy. So the retail occupancy actually increased 100 basis points quarter on quarter to 92.3%. So the lower rental index is actually was actually due to the weaker performing retail rents, as seen from the graph on the right. You can see that the fringe assets actually registering increase in rental. However, the central assets are the ones that are causing a lag or causing a putting pressure on the rental index at large. In terms of the Singapore retail sales index, for the most part of 2019, the RSI has actually has actually been negative. The same for June 2000 and the quarter ended June 2019. This was largely dragged down due to the furniture and household equipment trade sector, as well as the computer and telecom equipment sector. For the property price index for the retails, very much the same picture as the previous one. We see a divergence between the fringe and the central assets. So the fringe assets are the ones, the green one, which is clearly doing better than the central assets. So this is part of the reason for our accumulate call on FCT, amongst other reasons, and our neutral call on CMT. So moving on to the office subsector, the retail index and occupancy continues its upward trajectory. So the current rents are about 6.5 points higher than a year ago, while the occupancy grew by 0.7% year on year. And for the industrial sector, we can see that over the years, actually, the occupancy has remained relatively stable above 90 percentage points. This time around, it was flat quarter on quarter at 89.3%. And similarly for the rental index across all the subsector, all the asset classes, it also remained largely flat. So one thing that is worth noting is that for the industrial supply that's coming onto the market, actually a very little supply is coming on. For 2019, it's about 1.6% of the total stock, and for 2020, it's about 3.6% of the total stock. And for the stock, for the new industrial assets that are coming on, the supply is already 90% committed for 2019. So this will provide some support for the rents, despite the very grim manufacturing outlook. Similarly, for the office subsector, for the office space that is coming onto the market for 2019 to 2023, which is for the next 5 years, is actually 23% less than the 10-year average of supply that came onto the market. So this will also continue to help drive or support the office rents. So the last subsector is the hospitality sector. So visitor arrivals was mildly positive at 1.7% for the quarter ended June. Hotel RevPAR, on the other hand, was slightly lower at negative 0.8% year on year. So this lower RevPAR was actually due to both the lower average room rate as well as occupancy, due to the absence of the biennial events such as the Food and Hotel Asia Fair. So the global economic uncertainty has resulted in the tightening of corporate budgets, and this is partially mitigated by the uptick in leisure travel, which helped to make up for the weaker corporate demand. And we also noticed that increasingly there's a popularity of leisure travelers using service residences in comparison to hotels. So for the hotel RevPAR broken down by segments, we noticed that the luxury and the mid-tier segments are actually the ones that are doing slightly comparatively better compared to the upscale and economy. So this is our view is unchanged. We still have preference for the commercial and the hospitality subsectors due to the tapering supply. So for the hospitality subsector, for the CAGR of of supplies coming onto the market for the next 3 years is actually 1.5%. This is lower than the historical 3-year CAGR of 4.4%. So this bodes well for the hospitality segment, despite the weaker, softer tourism outlook. The table on the right shows you our calls, and then I'll move on to Jie Yuan for China Weekly Musing.
Thanks, Natalie. For China last week, after the China central banks combined the market-based interest rate and benchmark interest rates together, PBOC announced LPRs on August 20th. The 1 year's LPR is the 4.25%, down about 60 basis points, and the 5 years LPR is the 4.85%. Because LPR's the rate and MLF rate interest rate are linked together, we are not seeing the big interest cut because the MLF rate haven't been changed yet. PBOC will announce the MLF change today, but we are not seeing there will be a cut in this month. Based on the China's financial conditions index, we are seeing the cut is expected by the mid-September. We are confident about the China's interest cut because we are referenced as the China's financial condition index. It reflects 2 or 3 quarters interest situations in advance, and the data shows the China's monetary policies are stepped into the monetary loose. For the stock performance the last week, the CSI 300 up about 2.97%, mainly contributed by the consumer sectors. For this week, with the negative news of the trade wars, but we're also seeing the positive news like MSCI FTSE will further increase the China's Asia's inclusion factors, and also we are thinking the RMB's depreciation also will hedge some risk. Although still we are seeing the interest cut, but because of the strong deposit and the loans growth, we think it will be hedge the negative impact of the interest rate cut. For this week, this is the strong weeks for the company's earnings released. For this week, we are waiting for the Bilibili's and the Shanghai's International Airport. This is a list of our company's earnings release this week. I will move on, Edmund, for the US Weekly. Thank you.
All right, thank you, Mike. So moving on to the sector performance for the US, we can see that most of the sectors have done fairly well for the past week, even though there was ongoing escalation of the trade war tensions, with China decided to block all US farm purchases on Friday. So moving forward, we think that the consumer discretionary sector is likely to do well because of the strong retail sales holding up for the US sector. So today we'll be talking about 2 stocks. One is Merck & Co. and one is Microsoft. So from Merck & Co., we see 3 key drivers for Merck & Co.'s growth. So the first is the ramp up of Keytruda, which is its main blockbuster drug, and the strong Gardasil sales. So they reported Keytruda sales of 30%, which increased 30% year-on-year for the 2Q19 results, due to the strong uptake for the lung cancer space. We expect Keytruda to be one of the key drugs in the treatment for lung cancer, following its approvals from different countries such as US and in the international space. And for Gardasil, which is the type of HPV vaccine, it grew 50% constant currency year-on-year in 2Q19. And we continue to see high demand for the vaccine in both US and ex-US. Secondly, Merck & Co. also announced strong results for China, mainly because of the new launches and the drug Januvia making it on the NRDL listing. And it's likely to reap benefits because of the approval of Keytruda's lung cancer therapy, which is likely to make the NRDL listing as well. Last but not least, Merck commented that it is going to focus more on targets to boost a wide spectrum of its therapeutic areas, and we believe that the acquisitions will likely speed up the R&D programs and help to provide synergies such as combination therapies. So next we'll be talking about Microsoft. So for Microsoft, the first key driver will be the mega trend for cloud migration. You continue to see a lot of enterprises shifting towards hybrid cloud, and this could be one of the main reasons for it reporting a 68% year-on-year growth for Microsoft Azure for the second quarter 2019. And we expect the momentum for cloud solutions to continue for the next 2 calendar quarters. And as we believe in in Microsoft's strength in expanding its cloud offerings, and also its ability to obtain large commercial deals such as AT&T. Secondly, because Microsoft because a lot of its customers are currently upgrading their products to Windows 10, Office 365, and switching from Microsoft Server 2008 to newer versions. This could be a short-term revenue boost for the next few quarters as the customers will likely expand their usage because of the newer functionalities. So with that, I'll pass on my time to Wei Ren for the technical analysis.
Thank you, Eamon. So I'll move on to explain about Dow Jones. So for Dow Jones Industrial Average, our view is still the same as sharing session on the 8th of July and on 22nd of July 2009. As the price has unfolded the wave D, the D wave, and the 1-2 corrective wave has been formed. So we're expecting that price will fall further downwards to 2432 and 23,864 to form the last leg of the D wave and E wave. So why do we think that the further downfall is because prices has been testing the 26,000 psychological resistance level for 3 times, and prior to that, for every time it's tested, you fall below 26,000. So for the 3rd time, we think that prices are going to fall further. So and the price at 24342 is 100% of wave 1 and wave 2, and the maximum the last leg of wave D can go is at 23864.550. So therefore, we are still on bearish on Dow Jones Industrial Average. So now I'll move on to Paul for the Phillip Singapore Weekly.
Okay, thanks, Viren. Move on just our usual weekly update. In terms of the Singapore macro, I think the main number was the core inflation that came out in July. For July, it's 0.8. It's probably a 3-year low. I think more importantly, it is below the MAS forecast range of 1 to 2%. And also, as you know, looking at the bullet point, MAS had a forecast of GDP 1.5 to 3.5. I think the recent number by the Ministry of Trade is 0 to 1%. So obviously, this can just conclude that they are definitely going to taper down the currency. So just a reminder, in October they raised the slope last year, and then in April they mentioned that they will maintain the current rate of appreciation. So in the coming October, likely 12th October, they will probably just change at the very minimum, they'll just change the statement to 0 appreciation of the policy band. And another possibility is that they may just widen the band so that there can be a bit more downside to the currency. Unlikely to recenter. For those who are not in know, a recenter usually means a more aggressive move downwards for the currency. This is probably more similar to the 2008, 2009 recession, the global financial crisis period. Anyway, in terms of the other main data point, macro news was the Powell speech. I think a rate cut is obviously very likely now. I think two reasons from it. If you just take the context of the speech or his statements, is just that he will he will act appropriately to sustain the expansion, number one. And number two is that it was also mentioned that since the July FOMC meeting, there's been new tariffs and further evidence of a slowdown. The scenario that they are looking at is more like the 1998 scenario in the US, where even though US growth was very strong, as you know, 1998, there was the Asian financial crisis and the global economies were slowing. So even in that period, despite a strong US economy that was growing about 4%, they still cut rates. So that's probably the scenario. The other big macro news was the release of the ECB minutes. In that, they just said that they are preparing for a significant package. I think some of the commentary came out was that this is not my commentary. I mean, it is better to overshoot than undershoot because growth is disappointing. And also one of the more unusual commentary was that there's obviously going to be a resumption of QE, and some of the assets they might purchase could even include equities. I'm not sure how likely that is, but that's something that they are open to. Okay, something like Japan. But anyway, move on to the tactical. In terms of tactical, obviously, only a trade resolution can revive the market. I think all this rolling, only concrete resolution can only revive the market. And even rate cuts, as you know, the market has rallied the past couple of months on rate cuts. And even now, with all these rate cut expectations, equity markets are still going to be weak because, as we know, these rate cuts ain't going to revive growth. So even the Fed cut may not be suffice to placate the downside in the market. And the market is more like pricing in recessionary conditions with this type of exceptionally low rates. I think for us, from the top-down perspective, not because we don't really cover these stocks, but anyway, from a top-down perspective, most attractive in this kind of environment is probably the SGX listed US REITs. Firstly, as you know, rate cuts are coming. Rate cuts is really positive for all REITs, but for them, they are, compared to the Singapore S-REITs, they have actually superior yields. Most of the yields almost 6 to 7%. And of course, you got a very positive currency backdrop, and the US dollar is strong, especially against the Sing dollar. On the relative growth out of the US is growing much better, and also the interest rate differential. And also, you got this whole RMB overhang on Asian currencies. And of course, in October, you know that the MES is probably going to loosen the monetary policy, i.e. a weaker Sing dollar. Okay, that's it for me. At the bottom is all the key news. It's probably all just tariff cut here, tariff cut there. But anyway, the main one, I guess, is 17-18 September. It's the FOMC meeting. Okay, I think that's the end. Any questions? Yeah, thanks.
Hi, there's a question asking why the MAS meeting will be on the 12th of October, because that's on a Saturday. So we rectify our error. It will be on the 14th of October on Monday. Thank you.
Okay, just one question. Are we in a technical recession? I guess. Oh yeah, I think very high chance. For the third quarter, was all the indicators still pointing downwards? Technical in the sense that it's just 2 quarters of negative growth. Probably full year won't be a recession. Not that it makes any difference, but at least on the third quarter, you probably will see a recession because 2 quarters of consecutive quarter-on-quarter contractions. So very high chance. Yeah. Thanks. Thank you for the question. Another one is any update on telco share outlook? So sorry, no real change. I think because our analyst is away on a reservist. The only thing is that the only recent updates we got from, at least on the ground, is that really not much news happening at the TPG side. I think that's the one thing. Some of the suppliers we spoke to just said that there's really very, very quiet on the TPG end. And they're probably focusing more on what's happening in Australia rather than what's happening in Singapore. Yeah, sorry, that's the only update. I think when he comes back, we probably can give you more. Sorry for that. Thank you. Okay, can you explain again why US listed REITs will be attractive? Okay, but anyway, some of the reasons is that, again, the problem is that we don't have coverage on them directly, but just that from the top down, the yields are better. I think most of them trade 6% to even 7%. So that's number one. Number two, and you got a more favorable currency in the US dollar compared to what's happening in Sing dollar. So of course on the US, then you're also in a US economy which is much stronger. Number one, so the relative growth is better, and also you got in the backdrop you have this MAS meeting coming on the 14th, I guess. Sorry, not on the 12th, which is probably going to weaken the Sing dollar. And looking at the weaker Sing dollar, and also all Asian currencies are probably going to be under pressure when you have when you have this RMB weakening, because everyone, how the market views is that when RMB weakens, is technically like a competitor. All Asian currencies are like a competitor to China. Of course, not specific to Singapore, but in a broad sense. So it will also put pressure on Asian currencies, also including Singapore. Not to mention, of course, Singapore is also the most exposed to a weaker global growth and weaker trade outlook. I mean, these are just the general comments, but that's why we think the US REITs probably look the best right now. No, right? Okay. This is question. The US REIT DPU, I think, withholding tax of 30%. I think those are REITs listed in the US. Sorry, I'm referring to the US REITs listed in Singapore, like your Manulife, CAPL, KBS. So sorry for that confusion. Yeah. Of course, never buy never buy a stock in the US for dividends. You're going to get creamed by the withholding tax. On any comment, what is the short term on? We have another question. What is the short term of DBS Bank share? I think the last 1-2 months, obviously, you'll be under a lot of pressure or duress, because firstly, you're going to get a big exposure to Hong Kong. So probably going to affect some of their earnings out of the Hong Kong banks. And not to mention even asset quality possibly. And of course, the SIBOR has been holding up the last 7 months, but only started to crack the last month. So all this, there's a big swing, not big swing, but there's a incrementally less positive for DBS in the very near term because of Hong Kong and also the SIBOR weakening. As you know, Singapore, DBS always is the biggest, one of the big lender beneficiaries of higher interest rates because they got so much excess savings. So weaker SIBOR will affect them. So in that very short term sense, that is the weakness. Okay. Sorry, are you able to comment on Yang buyer? What is the opportunity? Sorry, we don't cover Yang yeah, sorry for that. No, can't comment on that. Thank you.
There's a question on the SDI technical analysis. Basically, for SDI, it has already broken down 3,100 psychological level. But however, we are still on the wait and hold position to see whether if price will rebound at 3,050. Thank you.
Hi, there's a question with regards to US REITs DPU withholding tax on whether it applies to Manulife REIT and others. They don't have any withholding tax. Yeah.
Hi, so we have a question about REITs traded in US dollars in the Singapore Exchange. Are they US REITs? So for short answer is yes. So currently there are Manulife US, which is the office REIT, CAPL KBS, which is also an office REIT. The newest listed office REIT is Prime US, also office REIT. Apart from that, we have two others, which is ARA Hospitality Trust, and the last one would be Eagle Hospitality Trust, ARA Hospitality Trust and Eagle Hospitality Trust.